The political elites are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, we're going to talk about the blowout non-farm payroll report and why we think it's totally fake, why the BLS had to cook the books, because right now we believe that the political elites are afraid a recession is coming. Now, if you look back to yesterday's show, what did we talk about? We talked about how major corporations are starting to cut back. They're laying off people, and the reason they're doing it is they're afraid of an economic slowdown. They're starting to believe it. How about the Federal Reserve? We'll get to them in a little bit, but they're completely trapped in a box of their own making. They're stuck. They have to buy into their own inflation narrative. And then we've got economists. You're hearing one after another come out and tell you that a almost certainty that we are going to see a second half recession this year. The question now becomes is what happens when people start to believe it is they cut back their spending. You saw that in the earnings reports from Apple and Google. Things aren't as good as they look, and yet here we have this blowout payroll report, and there's a reason. If you can convince people that the economy is actually better than everyone is telling you that it is, then people will spend. You give them the confidence there's jobs out there, they'll go looking for them. And so we're going to see today why I think the report is fake. Now, as we get into this, I want you to see just how the major news networks are reporting this. And I'm going to give you this snippet. We'll see exactly what they overlooked. But I want you to take a look. Now, let's start with Bloomberg. With the headline, U.S. payroll surprised with surge as jobless rate hits 53-year low. And you think, wow, that is fantastic. Non-farm payrolls increased 517,000 last month after an upwardly revised 260,000 gain in December, according to the report today. The unemployment rate dropped to 3.4%, the lowest since May of 1969, and average hourly earnings grew at a steady clip. The first question you should be asking is, how do you get a number that's so wrong that it has to be revised upwards by 260,000? So you first get the notion of this, because what we know about the headline survey is it's a smooth report. You shouldn't have these big fluctuations. But then all of a sudden, out of nowhere, you see this big number of 517,000. And that starts to give everybody the impression the economy's red hot, the labor market's strong, and if you want a job, well, all you have to do is go out and get one because they're waiting. The figure beat all estimates, and here's a key point. All estimates in a Bloomberg survey of economists, they said no way that number could have happened. They all called for 188,000, which actually makes way more sense. Hiring was broad-based across all sectors, led by leisure and hospitality, professional and business services, and healthcare. So again, you start to look around and you see, look, do you want a job? There's plenty of them. Now, we know leisure and hospitality are a lot of part-time jobs, and there's been this notion that we're going from interest in manufacturing and goods by the consumer to services. So again, this fits the broad narrative of what you're seeing in the media, but it doesn't explain the number. The figures showcase the resilience of the job market despite rising borrowing costs, a pullback in consumer demand, and overall uncertain economic outlook. Demand for workers continues to outpace supply, threatening to keep wage growth strong and fan further inflation. So you kind of get the notion you see, we go back, it says, hey, well, borrowing costs are going up, consumer demand is going down, and boy, there's uncertain economic outlook. So gee, who is hiring under these conditions? And yet, according to the BLS, well, lots of people are getting hired. That's been the key frustration for the Fed, as outlined by Chair Jerome Powell on Wednesday, after the central bank slowed its pace of interest rate hikes to a quarter point. Even so, Powell expressed optimism that officials can still pull off a so-called soft landing, in which they call inflation, without putting millions of people out of work. Now, yesterday we made this case. We showed you the charts of why inflation's coming down. We're not going to repeat that, but I want you to see what the problem the Fed has here is they're boxed in to their own rhetoric. They have to keep raising rates because inflation, in their book, what they've been telling people is, hey, if inflation stays up, we have to hike. Now, if you're the Fed chair and you know that inflation is coming down and the economy is slowing and you're seeing all this evidence, what would you want to do? Well, you'd want to pause. Maybe you'd want to cut a little bit, but instead you can't. So now all of a sudden you're tapped out of the game too. You can't play. You can't turn things around because you're trapped. The labor force participation rate, the share of population is working or looking for work, also went up, climbed to 62.4. The rate for workers aged 25 to 54 also increased. Again, a sign of good news. But here's the key point. We're going to come back to this, but I just want to give you this now because I want to look at the Wall Street Journal, who gives just a slightly different spin. Friday's report included an annual update to the population controls using the household survey data, which means the participation and unemployment figures aren't directly comparable to the previous month. Now, what I want you to see so far is there's two reports. There's the establishment survey, and then there's a household survey. They're done to different groups of people, and they come up with different numbers. But nevertheless, I want you to hang tight on this. Nowhere in Bloomberg did they talk about the household survey number. Now, let's go over to the Wall Street Journal. I want to look at a couple pieces from it because I want you to see how the major media is totally ignoring this because they want you to believe too. The U.S. added 517,000 jobs in January. This headline from the Wall Street Journal, who says recent figures paint to a mixed picture of economic health. While consumer spending, the main driver of economic growth, is starting to falter. Manufacturing activity is declining. Price increases are easing, partially as a result of the Federal Reserve's interest rate increases aimed at slowing the economy to bring down high inflation. But again, we come back to this and look, consumer spending, the driver of economic growth, is starting to falter. Manufacturing activity is declining. These are not things you hear about in a robust economy. So is everybody just missing out on eating out and they just want to go to a restaurant? Is that the driver of the economy? Well, let's keep going here and see where this goes. Still, the labor market remains historically tight, they said. On Wednesday, the labor market said employers had 11 million job openings, a data point we know is highly inaccurate, roughly 600,000 more than the previous month. There were roughly 1.9 openings per unemployed worker in December, up from 1.7 in November. On Thursday, the department said the first-time application for unemployment benefits fell to 183,000, as we talked about yesterday. So you start to get this picture that if Jerome Powell knew about the payroll report, which, by the way, he did, the Bureau of Labor Statistics will give the Fed an estimate ahead of time so they have an idea. So if the Fed really believed that number was true, why wouldn't they come out and say, you know what, I know everyone thought we're going to do a 0.25% hike, but we have reason to believe the labor market is far stronger than anyone realizes, according to our own internal data, which they could completely make up and not even give a number. And he could have easily said, we need to do a 50 basis point or a 75 basis point. But what did we actually hear? Well, we're going to do a 0.25%, maybe another 0.25%, and well, we're kind of concerned that perhaps, things aren't as good as we think. You'll notice he didn't make a big deal of economic conditions easing, something he had made a big deal about in the past, because he knows what is coming. And now you're ready for the evidence. Let's go back to that piece and read it again just so we have it. Friday's report included an annual update to the population controls used in the household survey data. So do you want to know how many jobs the household survey said were created last month? Are you ready for this? 84,000. Now, does that start to put this in perspective? You have one report showing over 500,000 jobs, 517,000 created, another one at 84,000. Which one do you believe is true? Now you start to think about it. Which one does the market care about? The headline establishment survey. You put a big number there, it's going to hit every newspaper, it's going to hit every radio show, it's going to hit every website, and people are going to talk about how great the economy is. And that's why you start to see the stock market react the way it is. And you say, well, wait a minute. This means the Fed will hike more. No, not exactly. The Fed actually said we're slowing the pace of our hikes. There's the other factor is the market's momentum driven, as I've been saying. And of course, I looked this morning, there's 28 coupons left at $20 for CTA Timer Pro. The machines, I've told you, are positioned long and likely to drive the market higher. And you're seeing that today. Again, 28 left at the time of recording. Here's some further evidence. We head over to the services PMI. We get this data today. The services sector went from contraction to expansion at 55.2. We see business activity up, new orders up, employment. We'll get to that in a moment, stagnating here. But look what they're saying down here. Economic activity in the services sector grew in January after contracting in December following 30 consecutive months of growth. So what you have here is a case where there's mild contraction in the services sector, and all of a sudden, boom, you see this big hiring effect from the establishment survey. Let's dig deeper in the report because there's a couple key things. We note, again, business activity shooting higher up to 60. That is a pretty strong number in these reports. You're now talking more euphoria in terms of how this is being viewed. New orders surging higher up to 64. Again, we went from 45 contraction to 60.4, but notably employment is at 50. Now, employment at 50 means this thing is unchanged. So what you're seeing from the government is huge surge in hiring. Survey data? Yeah, we're not seeing it. So the question again is you come back to the fact that you see the household survey at 84,000. When you take away those population control adjustments, you start to see the services PMI say, yeah, we're not seeing it. The question is why are they cooking the books? And the answer is because they're afraid. As BofA warns investors, risk sleepwalking into the sell-off. And here you go, another claim that we're headed into a recession. The most painful trade is always the apocalypse postponed. A team led by Michael Hartnett wrote in his note today, the risk as inflation flares up again over the next few months and the U.S. economy faces a deeper recession in the second half of 2023 after staying resilient in the first 6 months of the year. He goes on to say that he recommends investors start selling the S&P 500 when it's over 4,200 points, and he expects the benchmark to hit its first quarter highs before Valentine's Day. The strategist was rightfully bearish throughout last year. Those call for the bottom in the first 3 months of 2023 is yet to materialize. But again, if everybody starts to believe, this is the key point. You get consensus view across the board. We're going to have a recession, and you watch people cut their spending. How do you convince people otherwise? Well, the labor market is a great place to start. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.